consultant on the 3 co-ops in Chicago that were financed the way anybody would really love to get it, 100% grant in terms of the resident home ownership plans at Carmen Marine, 707 Waveland, and West Park Place. And so I've worked extensively with co-ops over time, and both in my role as a development consultant and now at HUD. So I look forward to this presentation. Steve is going to share programmatic offering in the way of financing, and we're also going to discuss briefly any refinancing opportunities for existing Section 8 co-ops. So with that, I'm going to ask Steve Ott, our Director of Production, who oversees our loan insurance programs and working with our MAP lenders, who are an essential part of any successful application. And I'll now turn it over to Steve.
Thanks, Dan, and good afternoon, everybody. Just a couple of quick introductory remarks. I've heard that HUD has a condo development program in the books, but apparently it was too poorly conceived to actually use it, and it never has been. So I'm not going to talk about that one. Second, I think as many people know, HUD's operating model is based on approved lenders representing borrowers and developers submitting applications to us for mortgage insurance. So borrowers do not apply directly to HUD. When we approve a lender's application for financing, we commit to credit enhance the loans through FHA insurance and the full faith and credit of the government, but we do not actually lend the money. And then finally, HUD's multifamily financing programs are named after the relevant section of the National Housing Act, which makes them easy to confuse and forget. Yeah. What I'm going to talk about today is Section 213, which is the program for new construction of cooperative housing. Like our other construction programs for apartments, there is one loan that serves as the construction financing. And then after construction, that loan converts to a permanent, long-term, fully amortizing mortgage. So the mortgage term in this case, and in other cases with our apartment loans, is up to 40 years. This is, as I said, fully amortizing, so there are no balloons, and they are non-recourse loans. Today's interest rates, just to give you an idea, for construction loans are a bit under 3%. And that construction rate also locks in your permanent rate. So that would be the rate for the permanent mortgage as well. The other derivative program is for sub-rehab of existing cooperatives, and that's Section 213I. We have used that program to rehab existing, affordable and market rate co-ops fairly regularly. But today I'm going to focus on the main production program for new cooperative housing, and that's 213. So in the transactions we see, there is a developer involved who forms the nonprofit corporation that will be the borrower of the loan. The developer, in addition to doing all the other things the developer does, pre-sells cooperative membership certificates or shares in that corporate borrower. So think of the unit, but under a cooperative, the purchaser of the unit is technically buying a membership certificate in the cooperative and not the unit. And HUD, unlike a condo, is insuring a loan to the cooperative as a whole, as opposed to the individual members or buyers. So before we close on the initial construction loan, which is what we call initial endorsement of the loan for insurance, there's a pre-sale requirement. And that can be up to 90%, but the typical scenario is that with an experienced developer, the pre-sale requirement is 60%. And then the developer will post what's called a guarantee agreement that essentially commits them to cover the carrying charges for any unsold units for a period of 5 years. And a share is considered sold and meeting that pre-sale requirement when the down payment is made. And that down payment becomes non-refundable when construction starts. So though we're financing a loan to the cooperative and not to individual borrowers, the HUD underwriter who's reviewing the transaction still reviews and approves each certificate or share purchaser. Somewhat like a single family loan credit review, but admittedly it's less rigorous in this case. After construction is completed and sales have reached at least an 80% level, the loan can move from the construction loan to the permanent loan, and that's final endorsement of the loan. So we really have two closings. We have a initial endorsement, construction loan closing, and final endorsement is the perm. If only 80% of the units are sold at that time, the developer, in addition to the guarantee agreement, has to fund an escrow for 1 year of the carrying charges. But once sales reach 90%, that escrow can be released and only the guarantee agreement applies. And then the project is officially turned over from the developer's provisional board that they set up when they form the entity that's borrowing to the board of directors at the first annual meeting. So in terms of loan sizing, most of the loans are sized based on a debt service constraint. That tends to be what controls the loans. And there is no debt service coverage. It's a 1.0 debt service constraint. So when you think about the rent, in quotes, that's really what covers all the carrying charges for the project. And by that, we're talking about typical operating and maintenance expenses, management fees. These are professional third-party managers that are involved. Taxes, insurance, and then in addition, there are reserves, the replacement reserve for future physical needs and a general operating reserve. And included in the carrying charges is also the debt service. So the occupancy assumption in underwriting is also 100%. We don't underwrite a vacancy. So for those of us who are used to underwriting apartments, it seems like there is absolutely no cushion or margin for error in these kind of underwriting constraints. But the general operating reserve gets funded up to 25% of the annual carrying charges. So that's really where the cushion is. And the replacement reserve funding also tends to be healthy to cover future needs. There are, as with most HUD loans, there are a lot of controlling criteria. And the other one that comes into play most often is loan to cost ratio, and that can be maxed out up to 98%. But in reality, the loans are controlled by debt service coverage at a much lower level, and they tend to be low leverage at 60 to 70% loan to cost. So that begs the question: where does the other 30 to 40% of the project costs on top of the loan come from? And that's really down payments from purchasers or equity. So I'll just say that almost every new co-op that we finance these days is elderly or age restricted at 62 plus. This model really well. This financing model works well for that segment of the population. They're retired empty nesters, downsizing, selling their home. They have a lot of equity in their home, and they put that into a cooperative purchase. So the more equity that's in the transaction, the lower the mortgage amount, and consequently, the lower the monthly carrying charges or rent. So rent tends to be comparable or lower than what it would cost to rent an apartment of, in a similar location of similar quality. So the affordable co-ops that we see, particularly family co-ops, are existing projects. Dan mentioned a few of them. They're proposed for rehab, and they're all subsidized by ongoing rental assistance through project-based Section 8. And in order to make this financing model work for affordable cooperatives, you would either need some significant development subsidy to write down the development cost, kind of to substitute for buyer equity, or tenant assistance to subsidize the monthly carrying charges, or both. We haven't seen that yet, given the scarce resources, and focus on using those scarce resources for affordable rental housing. We have had one project that may come to us from the West Coast. It's in Seattle, I believe, where there is development subsidy that's committed from the local municipality that's going to write down development costs. We don't have the details or whether that's going to be a viable structure yet, but we understand it's targeted to kind of a moderate income 80% level. So that's kind of a quick overview of the program. I'm happy to take questions, but I'll also say that the experts on cooperative financing are my staff in. If you look at a map of the cooperatives HUD is financed, they are almost all in Minnesota and the upper Midwest, quite a few in Iowa as well. More recently, we're seeing applications in Texas, Colorado, and the Pacific Northwest. But given their history with this financing program, the Minneapolis satellite office handles all the cooperative financing applications for the nation. So if you have a particular development concept that you're working on and you'd like to get into the weeds with that, I can certainly set up a call with them, and they'd be happy to answer questions, go into more detail about how the program works and could work for your deal.
I'm sorry, what was that, Rachel? You're on mute.
Unmute, Rachel.
Go ahead. I apologize. It's all yours.
Okay, I'm sorry. So I was going to move on next. The newest GSC, the National Co-op Bank. And with us is John Holclaw. As I mentioned, he's an Executive VP of Strategic Initiatives of the National Co-op Bank. And I believe joining you, John, is a colleague, Ryan Greer.
Yes, sir.
So I'll turn it over to you and Ryan to tell us about the National Co-op Bank.
Thank you so much,
Wyman?
Wayman. It's definitely good to see you. I think I participated in a Milwaukee-based webinar sometimes. So that said, good to see you as well as Mr. Harris from CCLF, and to be in the room with all other co-op advocates and cooperators. That said, my name is John Holclaw, and I'm with the—
Let me interrupt for 1 second. I'm sorry. Dan, did I hear you wanting to say something?
Well, I don't want to be interrupt a co-presenter. It's just, we talked, Rachel, that if there were HUD questions, we would take them following Steve's presentation because we have another commitment.
Absolutely.
I'm happy to wait if you have a question.
That's great, John. Yeah. Do people have questions for HUD?
I have questions for HUD, but I want to wait and see if there's any from the audience.
I saw one question, and thanks, Dan, for reminding me, about like the size of projects that you see. And maybe this is more like a Minnesota office question, but are there 100-unit buildings? I wonder if there's any 20-unit buildings, or—
Or better yet, what's your floor?
Oh yeah, what's your floor?
What's your floor?
Well, there is no stated floor other than it's got to sort of meet the definition of multifamily, which is 5 or more. But we do see some smaller co-ops in rural locations that are 20 to 30 units. We see larger ones that are about 100 units. Loan sizes ranging from 5 million to 30 million, of that general range.
And Dan and Steve, you mentioned and reminded us that the Section 213 is a mortgage insurance program. So who are the lenders who actually provide the capital that HUD Credit Enhance?
So there are about 80 lenders in the country that are approved lenders. Some of those, many of them are household names. There are divisions of banks that have lending operations. There are others that you wouldn't really know. What really happens when a loan is committed is that that basically gives you a Ginnie Mae security,
Right.
which the lender sells to the Ginnie Mae investors on the secondary market. That's where the money comes from. Those lenders who can sell them are also servicers, and they will service the loan. But we have a list of approved lenders. I can certainly let people know who the lenders are that are most active in the co-op space as well.
Steve, would you have that list on your website, or could you send us a link that we could share with everyone?
It gets updated regularly. I can certainly email that around. Yeah, the current one.
Okay.
Yeah.
Thank you. And then I just have one more question, and Dan and both of you guys know about WIDA, and I assume IDA and the other housing finance agencies. Why, Dan, aren't there more collaborations between, say, an IDA and HUD, with IDA playing that role of the lender and helping promote more co-ops in Illinois and in the Chicago market particularly? Why isn't there kind of a state federal collaboration around co-op financing, with HUD providing the insurance and the IDAs and the WIDAs of the world providing the mortgage capital?
Well, to be honest, I mean, it's because nobody has really pursued that question with us in my 8 years. There's, maybe this conference is a part of a momentum or something, but we partner with IDA, WIDA, MHFA all the time. And it's usually in the case of we're advancing funds under an insured first mortgage with all the great terms that Steve alluded to. And then the sponsor developer is getting development capital from the state agencies, maybe now through some funding that's come through the various CARES funding, and maybe might come through Build Back Better. And we partner in the sense that the developer brings us together. The developer is kind of the glue that puts together our loan with their soft money from the state agencies. We're not really advocates or policy role at Multifamily. We respond to applications. And we are lucky to have the strength of the Minneapolis history to give our region more experience, but everything comes from seeing an application. And the partnerships emerge from that source.
Thanks, Dan. And again, I want to just check, Rachel, Janae, any additional questions in the chat?
Yes, I see someone asked about, I'm going to read it. Our housing co-op, the Hub in Chicago, has 6 units. We are mortgaged by CCLF. They are great, but we had 0 success obtaining share loans. And one reason we've been told by banks is that we're too small. Any idea how smaller co-ops get share loans?
To be honest, we don't typically see co-ops of that size. And that's really, a share loan is not something that HUD is involved in, except for we have to, review the borrower's. That's all part of the analysis of the borrower's creditworthiness that when they are getting a share loan as opposed to using their equity. But it's not something that we provide or have a lot of familiarity with. I assume other panelists may know more.
Steve, let me follow up on that, because that's actually a good question. On your single family side, and I know you guys are multifamily, and I wouldn't hold you to having to be experts there, but isn't there a companion single family co-op product that would effectively be that share loan that's on the single family side of HUD?
I know enough about single family and what they do to be really dangerous. So I would assume so, but I just don't know.
Yeah. What about you, Dan?
I can't speak to it authoritatively, so I don't want to.
And then I want to come back because this came up in the earlier panel. And Steve, you talked about the economics, and of course, coming out of WIDA, there's a lot of similarities on how we look at real estate. So how do you guys look at that issue of resale? That's one of the issues that have come up. So your underwriting shows it makes sense. You see the type of debt coverages you need, loan to cost. I assume you do a market study, but what are you looking at with respect to whether or not there's a resale market that 5 years from now, when an owner wishes to sell or leave, that there's some ability for them to do just that?
I think a lot of the transaction structure is driven to address that issue, at least the ones that we see. They tend to be limited equity. So, appreciation of 2 to 3%, and not necessarily, whatever the market will bear at the time of resale. The other thing is, you can structure it as a fixed down payment or a tiered down payment. People seem to be focused on the fixed down payment because that's predictable for the future. If you do a tiered down payment structure anywhere from 20 to 80%, that's fixed for the life of the loan. Those 80% loans, that's going to be really hard to market and sell if somebody's got to come in, with 80% equity. So I think the transaction structures like that address those issues in the deals that we see.
Thanks. And again, one more time before Dan and HUD has to leave, are there any additional questions for our HUD colleagues?
I do want to get a point of clarity, Steve and Dan. Are we saying this 213 product is only for senior housing cooperative, or it can be utilized?
No, it's not. It can. There's no requirement that it be elderly. It can be utilized for family housing. I was just pointing out that the most viable deals and the ones that we are seeing all the time right now are elderly, just because the borrowers have that equity from a home sale, and it's an accepted living model in lots of places in the upper Northwest for the elderly.
And so just one last piece to the intent of that question of, yes, it can be used for other cooperative development. In that, we see that within the kind of the senior model of housing, and the ability to do equity as one nuanced reason why it's viable and it works. Why do you think in those that are family housing, family co-ops, are you seeing similar issues? Are you seeing they're not applying because of this equity issue?
We're just not seeing them.
Yeah, we're not seeing them at all.
Do we know why? Any
I think it's the issues that just the fundamental economic issues. The more you leverage up the loan to reduce the equity that's required to get in, the higher the monthly rent and service payments are on the other end. So in order for them to be affordable to work for most families, you really need either equity, or you need development subsidy to write down the cost of the deal, so you're not financing as much with the mortgage. That will reduce the income side. And Dan, I think, was talking about the old days, and those were the good old days when you had not only Section 8, but helping out on the income side. Also had grants to cover the development side, and so we have those legacy deals around, and we're refinancing and rehabbing them with various programs, but we're not seeing that now. And we'll see what comes out of Build Back Better. There's obviously a lot of opportunity potentially there, but
By way of reference, Janae, in the deals I've seen in Minnesota, which are elderly, the equity contribution is $200,000 to $400,000. They're big numbers, in terms, these are market rate co-ops with people that are selling in suburban locations and bringing in, significant, amount of money. And so I think that's the distinction with the family co-ops. There is not, typically speaking, in the family, if they don't have enough equity in selling a home, or, they haven't lived in all of their life, so, I think it's just why you would need for this to work and be affordable, commitment of resources from the public sector that has soft money resources, and have them elect to make it a policy priority to have some number of those dollars go in to balance the loan, whether it be a HUD insured loan or another loan. But I think we're not going to see 100% loans financing out co-ops and still achieving affordable carrying charges.
Thanks for that, Dan and Steve. And I want to reinforce, Janae, that what Dan was basically saying was that the fact is that probably for the last 40 years, the federal government has defaulted on its role for affordable homeownership. This is the 213 product could be used by anyone that makes economic sense, but in today's world, Dan was very clear, that's market rate, high net worth individuals who are selling existing assets of which they have wealth, that they're then converting that wealth into an equity stake in a co-op. That does not fit the impact of many of the people who are on this call. And that is less to do with HUD. In fact, HUD used to play that role. I started my career with HUD programs in that space, but our national governments have seen fit not to make those investments. And it's obviously clear that that's true also at the state and local level. And that gives us a great segue, Dan and Steve, to our colleagues over at the National Co-op Bank, which was started during the Carter administration to address some of the very questions, Janae, you raised. And so again, if I may, I'd like to introduce Ryan Greer and John Holclaw, I'm sorry, John,
No
of
worries.
the National Co-op Bank. And I turn it over to you guys.
Thank you so much, Wayman. And I think you stole some of my thunder there, but I'll make it work. That said, hello everyone. Again, I'm John Holtzclaw of the National Cooperative Bank. I'll obviously let my colleague Ryan tell you a little bit about himself. I'm going to just make this really quick because that was a great discussion and great questions for the HUD officials. As Wayman stated, the National Cooperative Bank was congressionally chartered in 1978, privatized in 81 when President Reagan started cutting back on some programs. But obviously was started to serve an underserved niche, cooperatives. That said, I think what makes the bank most unique is that it has this uncommon mandate per the charter that we must make best efforts that up to 35% of all of our disbursements be in low and moderate income communities. And so as time has gone on, it's really become part of the DNA of the organization. My job primarily is based around business development and thought leadership around co-op and community development, finance. So all my work is in LMI communities. That said, just wanted to give you all a little background on it. If you want to see our mission report or get any more information in regards to what we've done from a mission standpoint, please either contact Wayman or Wendell, and I'll be happy to get that to you. So with that, I'm going to turn it over to my colleague Ryan Greer, who's going to talk to you a little bit about the bank and its share loans. Thanks, Ryan.
Thanks, John. Hello, I'm Ryan Greer with National Cooperative Bank. I'm the Senior Vice President of Share Loan Financing. We handle 15 different states throughout. We specialize in conventional Fannie Mae cooperative financing. Also, we have a special book of business for portfolio financing to serve various communities throughout the United States, whether it's limited equities in those markets, senior housing community. We do have a separate channel for that. As far as kind of like what Steve was talking to before, those two different buckets of loans, there's night and day criteria. The conventional, Fannie Mae market rate cooperatives, you can, look at a 5% down payment. Credit scores can dip down to the low 600s. Reserve requirements are a little bit more lenient, but that's for your market rate cooperatives, where NCB has a special niche for many co-ops on this call is our portfolio financing and our specialized programs. I did have a couple minutes to look at the website on what this fund can offer, and we're very similar. We do require a 20% down payment for the limited equities. We are an adjustable rate portfolio shop, meaning, we don't have any fixed rate mortgage programs. We do have a 5, a 7, and a 10-year adjustable rates, 3.5% to 4.5% right now. So, very competitive on the rates there. As far as, credit score, you need a 700 or higher credit score. Obviously, debt to income requirements are just pretty much in line with conventional financing. So you do have to have enough income to support the mortgage and HOAs, and good reserves. So that's in a nutshell as far as, the two different channels that we have here at NCB. I'm actually filling in for the Chicago loan officer today as she's on vacation, but happy to, open up the floor to any additional product specific questions. I know we touched upon one that was, excuse me. So yeah, I know we touched, yeah, that's okay. We touched upon one. The question was, how many units in a housing cooperative can you do financing for? I thought that was a great question. We require a minimum of 3 units in the housing co-op to provide financing, 3 units. So we have several that are 4, 5, and 6 in Southern California that I'm in charge of that we do financing for. So 3 units was the minimum. As far as, project related, we like to see at least 50% owner occupancy on these co-ops. I know majority of limited equity in DC require 100% owner occupancy. So that's typically not an issue, but obviously a well-run, cooperative, good financials, significant, insurance replacement coverages and, good operating. So, from the project standpoint, that's always important to get that reviewed and make sure the co-op can fit our bucket for portfolio financing.
So may I ask a question?
Absolutely.
And actually, I'm going to put both Steve and Ryan, you on the spot.
Sure.
And this is a recurring theme, guys. Why can't you guys do what Chicago Community Loan Fund do of reaching low and moderate income and working families? And maybe a subtext of that, John and Ryan, is the co-op bank has a phenomenal focus in those 15 states, particularly New York, which I call the co-op capital of the US.
Mm-hmm.
But it looked pretty thin out here in Chicago and the Great Lakes. And so my first question is, why can't you guys do what CCLF is doing? And 2, for the co-op bank, what will it take for you to have a much greater presence in one of the largest markets in the United States?
Steve, you or me?
Well, I can take
I can go first if you want me to. So I guess to answer your question, as far as digging in the weeds, we are a national cooperative bank. We're a Federal Reserve Bank, right? So we are regulated by the OCC. One of those regulations for fair lending laws is the ATRM, right? The ability to repay the mortgage based upon documented monthly income. So we can't do any predatory lending, or the way we're regulated, provide financing when on paper they don't have the income to support their current debts or the HOA. So to answer your question, regulations. We're a Federal Reserve Bank chartered by the government by the OCC and regulated frequently. I know I'm audited every month to make sure that we are adhering by those guidelines. So that's the reason for that. In the second part, as far as, getting more involved in Chicago, I used to do Chicago lending back 15 years ago, probably. I've been with the bank almost 20 years now. So the issue that we always ran into was just getting everything from the co-op and getting an acceptable recognition agreement. I know, majority of the co-ops use, I think it was an old Aztec agreement that was created by some bank in the 90s that just kind of kept being reproduced by all the cooperatives, and they're not using a compatible, Fannie Mae recognition agreement. And I think that's not a non-starter for financing. We can, we're happy to look at certain Aztec agreements, but a lot of them don't have the necessary lender protections or, co-op protections to enable us to do financing. So I think the reason we don't have wish we had a bigger presence, but do not have a bigger presence is probably in part to the recognition agreement.
And Wayman, with that said, it doesn't mean that, again, I know that Calvin and Taft and several folks from CCLF have had conversations with Tessa Gaines, who was the loan officer for the Chicago land area. And again, so it doesn't mean that we can't have these conversations or try to work to build a better collaboration within the scope of what we can do from a lending standpoint. So again, that's something that I feel is not necessarily in Ryan's arena, but more in mine as the person who deals primarily with the CDFIs on a regular basis. That said, let's have a conversation offline. I talk to Calvin quite often, and let's just see what we can come up with from an education and outreach standpoint.
John, it's Calvin. I just want to jump in and share with everyone on the call that we have been working with NCB over the past year to try and advance bringing their share loan product to the marketplace. Having them as participants in today's summit is a part of that process of helping them appreciate what the needs are in the marketplace. And to Ryan's very technical comment about those recognition agreements, we're looking forward through the Center for Shared Ownership to helping the cooperative community understand how to get to a more acceptable recognition agreement so that we can bring NCB's share loan product to the marketplace. I just shot a message to Dan Korn in the chat saying that this is something that we've been working on for a year or so, and that's what John just alluded to. We're getting closer, and we really do appreciate the ecosystem's patience because the National Co-op Bank has some regulatory challenges that many of the unregulated CDFIs don't, and we're trying to thread the needle on that to still make sure that they're a viable resource for our ecosystem here.
And there was a question that said, please explain a recognition agreement. So I just wanted to make sure that was able to get in there.
Thank you. No, go ahead. That was a question that I think a number of people had on the recognition agreement.
Oh, sure. Well, yeah, I'll take that. So just in just a quick elevator speech for a recognition agreement, that is the bread and butter for, lien priority, and it recognizes the co-op's rights. It recognizes the lender's rights. And number one, in the unfortunate event, a foreclosure has to happen, basically, is the corporation's made whole, the lender who has first rights. Basically, it is a legal document that it does get recorded with the collateral stock and lease or mutual ownership contract, depending on the co-op, that coincides basically how things are handled when they go the direction that's not favorable.
Thank you. Any other questions for the National Co-op Bank to the audience?
Wyman, there's one question in the chat. I'll just jump in really quickly. Ryan, I don't know if you're the person to answer the question. John, I know you're on a different side of the bank, but we do have a situation in Chicago, particularly on the south side, where the Obama Presidential Center is creating some market conditions that might put some condominium associations, HOAs, at risk. Could you talk, could either one of you speak to NCB's condominium common element, common area financing products?
That's a very good question. Actually, Jared is a colleague of John and I's that handle all of that. I only handle the individual, share loan financing. So I can't comment on that, but we can definitely get you in contact with Jared to start that process for those types of mortgages.
Hey, Calvin, shoot me an email and I'll connect you with Jared. We're trying to get Jared on the call today. We just couldn't make that work, but shoot me an email and I'll connect you with Jared.
Okay, we'll do, John, and thank you, Ryan.
So Calvin, for the rest of us, could you explain what that is? What exactly the product is that you were requesting?
So the challenge, Lyman, as you know, is that a number of condominium associations don't have the capital reserves or the assessment payment history that make them creditworthy for traditional regulated lenders who provide HOA financings. The Center for Shared Ownership is working to create a table, if you will, of lenders who have products and credit boxes that are more malleable, so that these HOAs who don't have the fiscal profile to get traditional financing can still maintain their common areas, so that the out of town, out of country investors who are preying upon financially vulnerable associations don't have individual homeowners selling their units, so that those out of town vulture funds can actually take over an entire association and eventually deconvert that multifamily condominium building into a multifamily rental building, and then jack up the rental rates so that those homeowners get pushed out of the market. I live in South Shore. We just had a very large scale deconversion happen in the last 5 years. The neighborhood is very anxious that that trend will continue and pick up momentum. So we're working very hard to prevent displacement and keeping our middle income condominium homeowners in place in neighborhoods that are on the cusp of gentrification is really important.
And I see a couple questions there. I can knock those off real quick. Repeat the interest rates on the loans. That was 5-year, 7-year, and 10-year adjustable rate. Depending on credit score, down payment, you're looking at 3.5% to 4.5% on those products. That would be the range. As far as how small a loan can we make, technically there's not a dollar amount of the loan amount we can mortgage. Now, going back to the lovely federal government on regulations, we do have to be careful with financial regulations and closing costs being a percentage of the loan amount. Typically, we trip the old Truth in Lending and Fair Lending Act around 28%. When the closing cost is 28% of the mortgage, we're not able to legally do the loan. So we have to negotiate. We've had this issue in several co-ops, negotiate our fees, title fees, appraisal fees, and get those fees down. So, $2,800 to close, typically $10,000 is the lowest mortgage that, we can legally do. So I hope that answers that.
I saw a question from Carl. And Carl keeps putting up his hand. So Carl, would you unmute and ask your question, please?
I believe that's me.
Yes, that is.
Okay, that's Charles. I'm sorry, I should have my
I'm
full
sorry,
name.
Charles is abbreviated. Go ahead, Charles.
Yeah, full name is Charles Newsom. And I'm in the South Shore area as well as Kevin. And I think I kind of came in, I was rushing to get here and get online and to get this valuable information. I think what Kevin was talking about is such a concern of the community of South Shore, definitely with the Obama Center coming in, all those type of things. But what in life alone, there's an equilibrium that we have to try to control. Which way the pendulum swing? Does pendulum swing one way too long, swing the other way too long? Everybody seems to lose one way or the other. It's hard to hold it on the steady line. So I think that's where what we want to do, Kevin, I believe in South Shore, try to hold that steady line so it doesn't swing too far, such a way that the poor community will stay poor and no one else filter in. But at the same time, we don't want the rich community to filter in and push out the poor. So that equilibrium is so hard to hang on to. But I think we got something here. We onto something that we can all come together and create a vacuum that try to hold everybody together and dealing with this situation in life and our community. I mean, we all is proud of our community, but at the same time, I believe Kevin, someone said about the vultures coming in and swooping down on us and taking us when we're not watching. Mm-hmm. But we don't want to keep all of those things out. Everybody needs something. We need sugar and pepper and salt and stuff to make what we want to make. So it's hard to really hold it together, but I feel a sense of urgency, a sense of understanding that we all are talking about to really, really bring something together here that we can share with others, hopefully someday. So I'm sorry if I kind of went on a little longer there. I was kind of excited about jumping in and hearing the good, interesting things you guys are talking about. And we certainly want the community to be a part of it. Thank you.
And Charles, we're glad to have you, and just know that we share your values around balanced development.
Okay, thank you.
But Charles posed a really important question, Calvin and John and Ryan. And then we're at a point in our nation where, as the rappers say, big banks are taking little banks, taking the little guy out. And so if you work every day, middle class, you're being crowded out. So we live in an economy where the opportunity for people to own and co-ops provide a great opportunity. It just doesn't seem to be the level of opportunity. And in fact, in the spirit of what you're saying, Mr. Newsom, it seemed to me that we now have nationally what's happening in South Shore and in parts of Chicago is happening nationally. And that is Wall Street, through Wall Street, the people who extracted billions of dollars from Black folks through predatory loans took that capital and now are the dominant lenders nationally. So if regulated banks are now the minority in lending in these communities, don't have to follow CRA or no traditional oversight, it's these non-regulated entities, how can, from Calvin, your point of view as a CDFI, and John and Ryan, from your point of view of being a national bank, what can your two institutions do to provide a greater lifeline to these communities in Chicago who don't have a lot of financial wherewithal that's available to them? And you guys know what the degree of genuine CRA investing and initiatives going on. So in light of Charles' questions, what are those solutions, whether you have them or not? But in the context of lending, what's needed to address these needs?
Listen, I'll say this about the National Cooperative Bank. I mean, listen, we all see the news, the widening racial wealth gap and the tale of two Americas and whatnot. And like I said, again, I mean, one of the things that I take great pride in at the NCB is that we're not an investor bank. We're a cooperative. We're owned by our members. And so I got reamed out one time in a DC council meeting because the chairwoman went on and on about these investor bank. We're not an investor bank. We are a cooperative owned by our members. And so, you know, listen, we're $3 billion in assets. I'm not making an excuse about it, but we're not a Wells or a JP Morgan Chase or some of these other big folks. I mean, listen, I can't compare my overall amount of money that we do every year from a mission lending standpoint, but I sure can compare the percentage any day, you know. And so that said, I mean, I feel like, you know, for me in our organization, I mean, it might sound kind of a little cliche, but it's really for us, well, I'm in one community at a time. And so again, if it's Chicago, if it's Milwaukee, if it's California and DC where Ryan is, you know, and I can tell you this candidly, one of my biggest frustrations has been, it's hard in a regulated environment to do the kind of transactions that sometimes we like to do and whatnot. And so, you know, I don't know if I'm answering your question. I just wanted to differentiate the National Cooperative Bank from a lot of these other mainstream banks. I mean, we've done some work in the South Shore, and I still owe Mr. Harris a call on that as a part of it, something we had agreed to some time ago. That said, you're preaching to the choir, priest here. I just wanted to say that part in regards to the investor piece and us being owned by members. And I will yield back the balance of my time to Mr. Holmes.
Yeah, and Wyman, I would just say, and I do want to leave just a few minutes for Wendell to talk about the cooperative lending that CCLF has been doing for 3 decades. And not to be an apologist for the national regulated financial institutions, but it doesn't get picked up by the media as much, and community players don't necessarily see what's going on behind the curtain. But I would say, and I sit on Bank of America's National Community Advisory Council, I sit on US Bank's National Community Advisory Council, and wear other national hats. And sometimes the communications teams of the banks don't make it as transparent as it could be, but in many ways, the larger financial institutions are trying to work through what they perceive to be the regulatory challenges by dramatically increasing their investments into community development financial institutions, CDFIs like CCLF, so that we can be the last mile of financing where they don't know that they can tread comfortably given their regulatory environment. So as an example, those of you who followed the CCLF evolution might remember that, 3 decades ago, we had less than $5 million in capital. We now have nearly $140 million in capital. A huge portion of that comes from the very mainstream institutions that John just referenced, who are trying to figure out a CDFI strategy that allows them to still support working families, low-income families, vulnerable families. So it doesn't show up in the media the way that it might, but I can tell you that almost every major financial institution that has a presence in metropolitan Chicago is doing it through the CDFI ecosystem. So you might not know it's their money, but the banks are at play. They're very concerned and passionate about low-income people and places, and oftentimes they're leveraging that through their CDFI partnerships.
Thanks, Calvin. Very much appreciated. We are nearing 1 o'clock, and Janae, I think you have a message for everyone before we proceed.
And we've got to get, Wendell, do you want to say just anything really quickly before we pivot to the next panel about CCLS co-op lending?
What I really want to say is I think the direction that we're going is really important, right? I appreciate, Mr. Newsom, your comments around just kind of the climate where you are. I think it's good for all of us on this call to hear cooperative bank, HUD, et cetera, because there's an urgency of trying to resolve all of the challenges that are in the co-op space. I think just for the sake of time, I can leave it there. I think a lot of you all know kind of who we are and what we do. Again, a 30-year-old CDFI in Chicago, engraved and grounded in the roots of cooperative housing. We received our initial investment from the Weeboat Foundation in approximately $200,000, but it's since shifted to $100+ million fund. And we focused primarily, I would say more recently, on really trying to find resolve with some of our older co-ops where, leadership has changed, lack of succession planning, and most importantly, some of the co-ops that have some of the vacant units. It's really pushed us to kind of step outside of our space. And I say that being the vice president of lending operations, right? Calvin has had several conversations with me in the background on some different things that we're working on right now in conjunction with the city of Chicago and other partners. That's really forcing us to step out in a very unusual way. But is it really unusual if the end goal is to really allow vacant units in a larger cooperative housing development to be stabilized, right? It's just trying to figure out what makes sense, right? We can talk all the different products and services that are out here in the market, but what's most important is, are we trying to build a solution? And most importantly, build a solution together as a team like this to figure out how to keep this very strong, important tool in the affordable housing space live. I'll just leave it at that. I think that's good for right now.
I think that's good. Before you leave it, I have a little pitch to put on it in terms of, but the old, well, even today's car dealers, you see all of these flags and stuff, you can drive by, it's a car dealer. I think we need some of that in the financial institution, in the area that you can kind of drive by and know where you are and find you. The main thing, we need to be able to locate you. I understand sometimes they don't really want anything, but we got to make yourselves more visible and friendly in terms of, like the technology. It's got to be friendly, usable, so that we can get to those sources and so we can get to kind of help you know, everybody can get the kind of help they need. If you kind of understand what I'm saying, if we could.
Yeah, so I'd like to just a point of order, I guess, so everyone knows what their options are. This workshop here was going to 1:30, and Wendell was going to continue as the final presenter on the panel. And in a separate breakout room, there are an awesome team of attorneys who are available to talk and are going to be talking about condo law, Illinois specific laws about real estate. We know many of you are here with questions as well. So if you look on the bottom of your screen, this is a good time to transition. Where it says breakout rooms, people who want to go with the lawyers, go with the lawyers. Click on breakout rooms.
So Rachel, if I can just definitely please, if you want to come in, go into the breakout room, what you'll find in the room is Jamie Stevens and two others, not all lawyers. Jamie Stevens is a lawyer. We're going to focus on the Illinois law, how it impacts condos and co-op owners, HOAs, and boards. We hope you can join us.
And those of you who are staying for the co-op resource, the last portion of our session will be a presentation by Wendell that will talk about the Chicago Community Loan Fund programs. And Calvin, we really appreciate your getting involved, but maybe we should provide Wendell an opportunity to just talk about what your co-op products are, type of things you're doing for our broader audience. And so I want to thank both Ryan and John and Kelvin for your earlier comments. And of course, Kelvin, you know, you are always welcome.
Oh, no, thanks, Wyman. No, I'm happy to have Wendell get an opportunity to run through the features of our co-op to financing products. It's a great product and it's very flexible and very accessible.
Well,
So I just
on
want to
that
say
note,
thank you, Wyman,
sorry,
thank you,
go ahead,
Calvin,
John.
and
Great.
thank you,
Thanks,
Ryan.
John, and thanks, Ryan.
Thank you so much. And
Bye,
we'll talk
John.
soon,
Bye, Ryan.
Calvin.
Absolutely.
All right.
Bye-bye, guys.
Bye-bye.
And Mr. Harris, we turn the floor over to you. Why don't you tell us about CCLF co-op products?
Great, I appreciate it. I'm gonna take control of the screen. All right, are you all able to see the screen?
Yes, it looks great.
Great, great, great. So I'll talk through just kind of a short, brief series of slides to allow those of you all who may not be more familiar in depth with the Chicago Community Loan Fund, just to talk a little bit more around who we are, what we've done, and really how we're continuing to do that going forward. Again, as I mentioned earlier, the Chicago Community Loan Fund, we are a 30-year-old CDFI, nonprofit loan fund established in 1991. Again, initial investment of $200,000 has since grown, fast forward to 2021, to $130 million. Again, started out specifically in the cooperative housing space, but through the years, we've transitioned to be a real estate lender for-profit and nonprofit entities. And then we also help nonprofits and social enterprises with equipment and working capital, in addition to providing support to the market that we serve with technical assistance as well. We're comprised right now of 116 unique investors. As you can see, 55 individuals, 9 foundations, 40 corporate financial institutions. Again, primarily banks, because we are a CDFI, which ultimately we were developed out of redlining. 12 religious organizations and 2 agencies. Unregulated, which is key, as if you kind of go back to some of the conversations that we had earlier with our partners in the banking space. We're not regulated by the FDIC or the financial industry in that magnitude, which gives us a lot more flexibility and latitude to be a bit more agile and nimble. Been a CDFI since '96, but again, started in 92. To kind of elaborate a little bit more on our impact and how we execute from an impact standpoint, from a comprehensive standpoint, again, housing, retail, community facilities, social enterprise, lending, and again, with a wraparound of technical assistance. We have done much of our work in Cook County, but we also serve the 5 coloring counties as well, DuPage, Kane, Lake, McHenry, and Will. Right now, we've leveraged more than 1.5 billion in additional public and private sector capital for community projects in roughly 70 communities, created or retained more than 11,000 housing units, helped to keep in place approximately 6,500 jobs, and helped to keep in place approximately 12 million square feet of commercial retail. We've closed over 550 loans, totaling about 260 million in financing to over 300 unique customers. So again, in a simplified form, sometimes I explain it as 2 pillars. We have the nonprofit, for-profit, real estate focus, as well as the social enterprise and nonprofit lending space, and then we support it with technical assistance. From an equitable housing solution standpoint, we were founded based upon a theory of change that really focuses on empowerment, agency and control, community equity and ownership, as well as financing project types that have difficulty obtaining financing ultimately. From a history standpoint, first cooperative loan was developed in 93 or was issued in 93. And I actually have a bit of an update. I think right now, we're actually at roughly, I think 39 co-op housing deals. And I think the totals are slightly off. I have about 14 million. Don't have the units offhand. Broader, we actually have roughly about addition to about just under 600,000 in workforce related co-ops as well. Sample cooperative housing loans, acquisition rehab, porch and balcony, facade repair, facade renovation and improvements. Ultimately, beyond just kind of laying out, here's what we do, we ultimately try to help find a solution for what the cooperative needs, right? From a specific structure standpoint, maximum loan to value right now, we're going up to about 100%. Terms, we can go up to 20 years. Amortization, which can help support a smaller loan payment, which I think the gentleman from HUD, Steve, was kind of referencing earlier. Our rates are roughly between 6 to 8%. Our pricing is much different than the traditional banks because our capital comes from the larger financial institutions, and they are unfortunately looking for a return on their money. Multiple principal and interest with balloon at maturity or fully amortizing loans when it makes sense. Up to 2 points. Application fees, 250 to 150. For the co-ops, we're looking at 150 because we are categorizing that as a nonprofit. No bank and legal fees right now. We are primarily using the law project, and they provide us with services on a pro bono basis, and normal closing costs apply. Closing costs right now roughly are estimated about 3 to 5%. From a construction standpoint, we are required on all loans exceeding 5,000 or more to fund the construction through the title company, security, of course, first mortgage, lien preferred. Again, we're offering technical assistance as well in conjunction with our partners via CSO and some other community partners as well. Project restrictions. Again, I talked about the markets that we cover, which is Cook and 5 Collin counties. Borrower restrictions must be a housing cooperative, of course, organization, nonprofit, or limited liability corporation. Income of end users must not exceed 120% of AMI. Many permanent mortgages as well, but primarily a lot of the co-ops we've looked at has all been more longer term. This is just some general criteria as well, in addition to acquisition, rehab, repairs, and additions. Again, our technical assistance support, definitely CSO. Again, technical assistance, capacity building, which has been really key. Kind of going back to some of my initial commentary around supporting some of the older co-ops in Chicago, community targeted workshops and teach-ins, which is very important. Workshops for potential new shared ownership. Again, CCLF specifically is offering underwriting and loan servicing for credits. In addition to that, we're also supporting cooperative communities of Chicago's website and all the resources that they offer. And that is it, and I am open for questions.
Any questions from Wendell? So Wendell, could you talk a little bit more about your portfolio? And Steve earlier kind of gave us a really good idea of kind of where their sweet spot is or what comes through the door. So describe your portfolio to us. Give us a summary of the type of deals you've done in the co-op space.
And I touched upon it earlier, and just to, I guess, kind of bring it out even larger. So historically, we've done about 37 co-op loans to the tune of roughly about 17 million. And again, breakout roughly 30,000 for about four. We've done two, and that gets to about 2.39 million. And in the workforce space, we've done about 5 workforce co-ops to the tune of roughly $600,000. Beyond co-ops, again, we've looked at all types of real estate deals in the Chicago market, anything from vacant land acquisition for future development to small 1 to 4 unit projects where we're supporting local folks, acquisition, rehab, sale, acquisition, rehab, hold for affordable rentals, multifamily 5 units or more, acquisition, rehab, refinance, mixed use community facilities, as well as large and small scale commercial retail, you name it. If the community has some sort of asset in the community that may have been vacant, abandoned, and collectively the community or a group of developers or a developer has a concept or idea that makes sense and can help support additional investment in the community, we want to be that go-to. So I say all that to say there's kind of a large area that we play in, specifically from a real estate standpoint. And then in addition to just supporting all of the real estate activity, housing co-ops, by supporting other types of social enterprises, and also by supporting other types of nonprofits that help support the people in the community, if that makes sense.
And you provide both blanket loans as well as share loans?
So we provide co-op loans as well. And when you say blanket loans, I'm trying to make sure.
One loan for the total co-op versus
Yes,
co-op loans for individual members who wish to buy in.
That's correct. Yeah, we do not provide loans to the individual members that are trying to buy into the co-op, right? To pay the upfront cost. Yeah, we do not provide that service. We provide the blanket loan to the breathing co-op, the entity.
Got it.
Yeah, so Wyman, I mentioned it earlier. We've been working through the Center for Shared Ownership for over a year to try and bring share loan lenders to the marketplace. And the dialogue that we've created with the National Co-op Bank is part of that. We're trying to help other share loan lenders at the national level come to the marketplace, recognize that there's an existing ecosystem that needs to have that product available. So we're hoping that if we can continue to figure out exactly what their product parameters are, educate them about the existing ecosystem of limited equity housing cooperatives, they'll see that this marketplace is robust enough for them to spend the time marketing their share loan products in Chicagoland. But we do not provide those. We're not a consumer lender. We're a business-to-business lender. So right now, we're just doing the blanket mortgages for multifamily cooperatives. And as to answer part of your other question, our cooperative customers over the 3 decades have ranged in size from 312 units with the Cambridge Manor Tenant Council to the smaller cooperatives who like Hub, Dan Korn is on the call, and his co-op just has 5 units, but we've had some even smaller at 4 units. So anything from a 4-unit cooperative to a large 312 unit cooperative.
Wow, that's pretty significant. So Calvin, is the share loan the impediment for this issue of a market for resale, or is it other factors beyond just the share loan? And again, Calvin on Wendell for that question about what's needed to have a healthy market for resale.
I'll let Wendell go first. He's a little bit closer to the actual deals than I am.
Yeah, so I think it's a mix of the share loan piece has been sort of a challenge. And I would say specifically with regard, and Calvin may have a different opinion, specifically in regard to the smaller co-ops, right? So like the 4 units and small, because we've been having conversations with some local centers of influence of trying to look at just that 1 to 4 unit space. And that definitely seems to be a bigger problem at this point. Calvin, I don't know if you have any other commentary.
I would say that, and Wyman, as you well know, in the neighborhoods that are either in the arc of gentrification or on the cusp of gentrification, the acquisition costs, particularly for de novo cooperatives, is a lot steeper than it was 30 years ago. So when you factor that into what the share price has to be in order for that co-op to move forward, that's become a major hurdle as cooperatives have tried to come into formation or if they've needed to recapitalize. So we're working now as the Center for Shared Ownership, and you heard Dr. Sutton talk about the new perspective the city of Chicago has, and how the mayor's office of equity and racial justice and the Department of Housing are working through their new community wealth building framework to bring more supports to the cooperative system across the board, where we're hoping that there will be some additional resources to help cooperatives still bring forward developments that will be affordable to the prospective member that's between 60% and 100% AMI, 120% AMI, because they will actually now have hopefully a subsidy partner at the city of Chicago level. Fingers crossed, there's some indication that the city's thinking about it in that way. So we're working at the Center of Shared Ownership to bring those tools to the fore.
Yeah, and I think that's the conundrum, which I think we touched upon earlier when Scott was talking, right? Getting that appropriate loan to value ratio right around 60%. That's challenging, trying to do something like that in Woodlawn, right? With the prices skyrocketing and outside investors coming in and buying up some of these assets, it's making it real difficult. So I think all the work that CSO is doing and Calvin is doing kind of with the city is really trying to help bridge that gap ultimately.
Thank you. And a question similar to what I asked of HUD on how it collaborates. Do CCLF work with IDA as a potential capital funding source that would play that role of supporting you of being the first adopter and on the ground entity supporting lending? What's your relationship with the state's housing finance agency?
Well, we have a good one with the new director of IDA, as you would imagine, Wyman, and we're in conversation.
Okay. And Wendell, your point about the 60 is very valid. That, as well as this broader force, that it appears that we're at a unique time in our history. This year, The Joint Center talked about the largest year-over-year increase in real estate ever recorded. The story this morning is double-digit increases in rents. Even middle-class families feeling rent increases that are questioning whether they will be able to stay in their place. What's needed from your perspective that would of how co-ops and CDFIs can play a role in helping address these unique and special housing challenges facing our nation?
So Wyman, as you know, that's why the Chicago Community Loan Fund and the Chicago Rehab Network created the Center for Shared Ownership. We see it as a vehicle to educate working individuals and families about the important role that housing cooperatives can play in providing them with housing sustainability that they can afford over the arc of their lifetime. I think everyone on the call knows that the rate at which your cost of housing increases when you are a share member of a cooperative is much lower than when you are in homeownership, traditional, or when you are in rental. And we want to educate more people in Chicagoland about the values of this really unique housing tool and to get them to both seek out existing housing cooperatives. It's hard to know the exact number. We think there are roughly about 100 of them in Cook County at least. We've created the Cooperatives Community website, which I think David Feinberg and our team put in the chat at one point, which is trying to be a clearinghouse so that consumers, if you will, prospective cooperative members can see these cooperatives and be able to reach out to them to buy shares and to become a member. And we're also at the same time, besides working on educating the consumer, the share buyer about this robust ecosystem of prospective places to which they can find a home, we're trying to work with the public sector to put the types of subsidy and supports in place so that it's easier for the existing housing cooperatives to sustain themselves as they go through capital improvement needs and for new information communities to acquire properties, recruit new share members, form their associations, and run their multifamily properties. So we're trying to do both of those in tandem. And I know that Rachel Johnson from the Chicago Rehab Network is on the call, and she may also have some other points that she wants to make to respond to your question.
Rachel, any additional comments? Unmute.
I guess I'll just add that we're all frustrated about the cost of housing, and we know that people are aging in place. So we have to have tools available for people to have their buildings preserved. So that is top of mind. And you know, kind of the other driving force in this effort is that so many good rental buildings, good rental owners have waiting lists, thousands of people on waiting lists. And the city really funds about 2,000 new rental units a year. It's the city in Ida. So that is where it's at. And so in our view, we think that we can connect people on waiting lists and move them into co-op options and create wealth for people that otherwise would not have access. So, you know, I would encourage you, I know that especially parts of this earlier workshop with HUD is really complicated for all of us. And our intention is, and we'll get back to this Post-it board so you can jot down questions and concerns. We will be scheduling more intense, specific trainings that go through the particulars and finance pro formas, how to think about where to get the equity they're talking about. Is it from the trust fund at the city or the trust fund from Ida? Or do we need to talk to politicians in our area? These are all next steps.
One more
So-
question, if I may, and Wendell, could you speak to what you require and are doing in two areas? One is TA for sponsors that want to do co-ops, if anything, and then what do you do or what do you require for training for co-op members?
So actually, Calvin, you want to talk more in detail around some of the things that you've definitely really heavily been involved in lately?
Sure. So Wyman, so historically, we have worked closely with cooperatives information at the governance level to make sure that the 4 households or the 5 households or the 6 households or the sort of organizing body of leaders of the cooperative information are really individuals who have collective impact values, that they understand what it means to self-govern, that they understand what it means to be responsible if it's a larger building for asset managing the property management company, that they're willing to roll up their sleeves and to be a unified team to manage their property. That being in mutual housing means that unlike you would in a rental scenario, you don't quite get to be a turnkey resident of the property. That you've got leadership, you've got governance, you've got responsibility. You need to be fully engaged all the time. So we sort of start there to make sure that the prospective group of owners of this multifamily property really do enjoy working together to govern the building and the property, and trying to help them appreciate how much they need to be simpatico from day one, and that if they don't have good meeting and negotiation and conflict resolution skills, it'll be very difficult for them to succeed in the long haul, and they have to believe that in some ways they're part of a movement, and that working together to create equitable, sustainable, financially affordable housing for each other is actually what they're all about. So we try to make sure that they, for lack of a better phrase, Wyman, that they've drunk the Kool-Aid. And then once we can establish that, and even with the larger associations, there's usually a core group of folks that are really driving that. So if we can establish that, then we work with them on their acquisition strategy, their development budgets, how to build their capital stack, which national and local entities they can turn to for additional skills building so they'll be successful over the long haul. And then, as you can imagine, as a lender who has a sweet spot for cooperatives, we want to make sure that we're bringing our flexible patient financing to bear as they get closer to acquiring the property and needing capital to rehabilitate it to make sure that it's a high quality residential experience for all of their members.
Thank you, Kelvin. We're at the end of our time. I'm just want to check if there any pressing question that anyone has. Now is the time while we still have these great presenters.
I've got one, Wyman.
Go ahead.
Is there anyone in the room that is considering forming a new housing cooperative, and how can we help you?
And for those who are in the audience, if you go to reaction, just do a thumbs up. Just an immediate, just let us know. There you go. I see LaShawn has answered your question, Calvin. Are there any others? I see Geraldine. Thank you. Any others?
David, you're taking notes, right?
Rowena?
I am.
I think I just saw Geraldine.
Terrific.
Yeah. Wyman, I'm going to throw my contact information into the chat so everyone has it.
Yes.
You can feel free to connect with me as our conduit and resource on the CCLF front for technical assistance.
Absolutely.
And one other thing that I want to share with everyone is as an unregulated financial institution comprised of lenders and technical assistance providers who are embedded right here in Chicago, we are incredibly patient with our cooperatives. We always encourage our communities not to bury their heads in the sand if they've run across an issue, just tell us. We're going to put on our thinking caps. We're going to call Rachel and Janae to try and think that through with you to help you get over whatever hurdle or obstacle you are confronting. We are not, even though our office is downtown, we do not think of ourselves as downtown players. We've got a fabulous partner in the Chicago Rehab Network. Between what they know and what we know, and even what neither organization knows, we're going to go out and find what we need to know so that we can help you be successful. We are very passionate about shared equity housing and neutral housing, and we really want to serve as your allies to be successful so that your family will never have to worry about being displaced.
Thank you, Calvin. And Rachel, how are we up for time?
We should just hang together for 2 or 3 more minutes. Let's take a moment and get to this Post-it board here so people can type out their questions. Should I share my screen?
Yeah, and there were a few additional questions that came in. Please add them now to the board.
Right on.
Questions that you had. Thank you.
Well, I mean, it looks like we have LaShawn and Rowena who, I don't know if you're raising your hand for a question or.
Hi, yes. This is LaShawn Brown, and I work actually in the South Shore community and also in the micro market recovery program. I was just curious and hopeful. I was just so excited about the opportunity to perhaps build a cooperative community. But in that area, there are so many resources that are targeted in that community, as well as pilot programs. And I just wanted to comment that I'm very excited about that opportunity and would love to work very closely with anyone who could be helpful in providing information on formulating cooperatives, because there are some troubled buildings. And if they were to go into receivership or whatever, many times there are people who live in those buildings who would be very, very interested in becoming a homeowner through that resource.
Well, LaShawn, you know exactly how to find us.
I do.
We'll be looking for that email.
Thank you, LaShawn. And Rowena, I think you had a question also.
I did. I wanted to know, because I know you were talking about the condos being converted to rentals, but I'm dealing with the situation of a rental that right now is for moderate income people, I would say. I don't think they have any very low people in the lower category, but maybe lower to moderate that may come up for sale. And I was asked a question earlier about that Chicago ordinance about notifying the residents, but the period is so short, to talk about purchasing a large building. So what does a person do in a situation like that? It's a large building. We're talking 300 units that is being contemplated for going for sale. And the residents don't know it yet.
Oh, boy. That is serious. Right.
And it's in a fast gentrifying area. It's probably a
Which
large
community, Rowena?
building, Woodlawn.
Are you a resident of that building?
No, but I do have a vested interest. I'm not a resident though.
So some of the questions in turning around troubled rental properties that, have to be asked are, is HUD involved? How is the city involved?
No, there's no loan on the building. The building is paid in full. So the can do
There's no use restriction on the land?
Not that I know of. I know it probably takes deeper investigation, but I don't think it is. But I do know that there is no mortgage.
Yeah, I think the first right of refusal in the Woodlawn housing ordinance, Rowena, only applies to the government assisted buildings.
Oh, I see.
I think a building that's fully privately owned, the government doesn't really have any leverage there.
Wow.
However,
but there could be, and I can show you how to look up all the contracts.
Okay.
It can be privately owned with one or multiple Section 8 contracts on it, maybe on all the units or on some of the units. And that would
make some affordable.
Well, that would bring in, right, government players to protect tenants. And yes, it's possible to intervene in finding a new owner.
Right, because it needs to be stopped because, and I know that there's a large number of vacancies there, you know, so, and needs a lot of renovation, but I mean, that would help tremendously. They could do something like that for people that will be displaced from some of those smaller buildings that are being sold and turned into market. Then you've got the university right there. You've got people who work in the university, maybe lower income or whatever, that would like the opportunity to live in something similar. I think it needs to be a limited liability cooperative. There's also vacant land attached where the townhomes could be built, or single family, maybe some single family homes, more of the modular, type. If you could do something like that, you could hit every income segment. You could, people that may be a little bit lower income could be in the building, and people who are maybe 50 to 60, 70% of AMI could be in the townhomes. People at 80 to 100 could be in the homes. You could create a whole new community.
Right.
And
so Rachel, we could,
go ahead.
I was just going to say we could follow up, Rowena, about the property, maybe triangulate with the preservation compact and see what we can do to create an intentional housing cooperative out of this community.
Yeah. Because it's going to take some fast movement, because I'm telling you, it's coming, and I know it. It is coming. And as I said, a lot of times when these things happen, then it just, it'll just roll, and we don't want that. It needs to be kind of nipped in the bud right where it is.
So part of just to give you a little example of something similar, you remember Grove Park on Cottage Grove.
Oh, yes.
And we were able to intervene at the request of residents, tenants there at the time, because everyone was talking about what should happen and what should be and how valuable that land was. And so, by getting HUD involved in the city and kind of setting a value of people shouldn't be displaced. The people that live here already need to have protections and options. And that really turned into HUD providing lots of money to build what's there now. Not that it's perfect, and I'm not saying that people weren't displaced, because there's always, unfortunately, circumstances, but I think I know the building you're talking about, and it's a big deal. I agree. We can't really lose units, can we?
Right.
Not at all. So if people are done with their comments, I do want to make sure that Wendell, we say thank you for your contribution and your time, and Wyman, especially, you've been with us all day and you're coming back tomorrow, and we just are really learning a lot from your not only your past experience, but your forethought about, how we have to create collective systems in order to deal with the world we're in.
Well,
so thank you so much.
And
Yes,
I just
thank you,
said
Wyman.
great panelists, certainly ending with both Calvin and Wendell. And again, I want to thank everyone for attending and for the great questions that we had and the great discussion. So again, I want to thank you and Janae for inviting me to participate.
Let me just pull up real fast here. I'll need some help though. I need to pull up the agenda for tomorrow. Well, let me just tell you, tomorrow we're starting at 10. So not at 9 o'clock. And the first part of the day is a panel of 5 different co-ops, small to large, where people are going to share their priorities, how they've balanced affordability versus stability, how they've balanced people getting equity, how they've paid for their building, these kind of variables. And you also will get a reminder, and you'll see a link tree where we're keeping bios, the agenda, and also documents related to the topics we're discussing. So you'll see in the link tree on the bottom is a survey, and it's a request for assistance. And that's kind of the first step in raising your hand and saying, help me. We want to talk, we want to meet. Here's the circumstances. Yep, here's a link tree. This looks familiar to folks, I hope. This is just like a big, a big file folder. And the survey request for assistance is right down here and asks a bunch of questions that helps us prepare to assist you. Okay. People can go over to the breakout room if you like and join several condo and co-op experts. Otherwise, we'll see you in the morning at 10.
Thank you all.
All right, thanks again, Calvin, Wendell. And for all the audience, see you tomorrow.
Thank you.
Thank you.
Thank you.
Thank you.
Rachel here. So a couple people that haven't joined the breakout room yet, but most people are in the breakout room if you want to move over there.
Most people went over there?
Yep.
That makes me so happy because they're so good. Do I need to move over there?
That's totally up to you. If you would like, I don't see why not.
Okay.
I'm just gonna hold down the fort in the main room.
Yeah, I'm sorry for not keeping track of my links. It's really.
It's all good. It's a lot.
Yeah, but your materials are just stellar.
Thank you. Appreciate
it. I will give anyone a reference for you anytime. Anytime of day or night.
You can't see me bow, but I appreciate it. Thank you. It looks like we have some more people. If you guys are still coming in, if you click the more button on the bottom of your screen, or if your screen is maximized, you'll see an icon for breakout room. We got our lawyer government breakout or governance breakout room happening right now. If you guys want to move on over.
Jamie's voice is so meditative that it'll just make me want to take a nap if I listen to Jamie.
Very true. He's very meditative.
So calm. It's funny. It's funny how he says, like, so if the.
Hello, somebody.
That was Sheila. Hi, this is Sheila.
Hi, Sheila.
Hi, Rachel. How do you join the breakout room? I'm multitasking. I'm sorry.
if you go to the bottom of your Zoom screen, if it's minimized, you might see more. You click the more, and then there's breakout rooms. And if you click the breakout room button, it should give you an option.
I think because I said, I'm going to rejoin the call and see if that does it.
Okay.
Yeah,
I have breakout rooms just in the bottom of my.
Yeah, you know what? I assigned her and she might have declined.
Oh.
So that's what happens. If you decline, you can't. It's weird. I don't, not super intuitive. Here we go.
You got her? Yeah, you go ahead and assign her. Sheila, we're going to just assign you. We'll put you in the room, hon.
Okay.
Yeah, let's see.
So I am going to jump over there, but I don't want anyone to know I'm there. Wish me luck.
I don't know if that's possible, but good luck.
I know.
if you guys are still there, if you do want to go into the law and governance, that is the last session for today. If you exit out and come back in, it'll be a lot easier if you're having troubles trying to get in there. But if you do go to the breakout room icon on the bottom, that should have a good start for you. Hi there. We're actually doing a breakout room for our last session. So if you want to go to the bottom of your screen, hit the breakout room and you'll be able to hop on over there. Hi, Taylor. I don't know if you can hear me, but if you can, we're actually doing breakout rooms for our last session. So I will give you, it looks like it's automatically asking you to join, but if you go to the bottom of your screen, you should be able to hit more and then be able to go to the breakout room. Awesome.